Good evening. This is Ken Long from Tortoise Capital, and I want to review some intraday trades from our trading chat room today, but I want to start by connecting those trades to the current market conditions. This is September 30th, 2015. We're looking at about 4 months of daily charts here. About 30 days ago, we had that market sell off from 212 swing high, collapsed here through 204, and has now sold off around 10% from the highest high of that swing. And what you can see is this sideways chop with a lot of volatility here once that selling was over. And this has not been very good for swing trading because the fact that we're below the 200-day moving average, so it's a bearish market and very volatile. But you can see by the size of these daily ranges that there have been some days when there's been a lot of intraday signal, intraday trending. And so in our general strategy, we're de-emphasizing swing trades because we don't expect as much follow through, and we're still looking at those swing trade setups, but as a way to find symbols that are more likely to move large on a one-day move with intraday directionality, but not expecting any follow through. So we call that swing trading one day at a time. So we've had about 30 days of this sideways volatile chop. We had some support down here around 188. Yesterday was a doji day. We had a gap up opening and then a higher close. So we're still in the bottom half of the river. We're a few percentages off the swing low. We're not back to the Bollinger Band mean yet. We're still down here around 10% sell-off. So still bearish conditions and volatile, which is a pretty good condition for intraday trading, actually. So now I want to shift over to our chat room, and this is some of our text. This is archived with thumbnails and searchable, and so we can actually go back 6 or 7 years and take a look at different ideas as they get expressed over time. And so one of our chat roomies asked me to take a look at this trade. This was in TLT, and his first, so now we're looking at intraday on 3 minutes. You can see the river in dark blue, the floodplain in lighter blue, the Bollinger Band Z score of plus or minus 3 in the outside red. And so he went long here when the 10-period regression line left the dragon sloping up, had some chop, and he essentially scratched the first trade here at the red dot. The price collapsed down to test the daily low, and there's a minor bounce and then rolled over. And so his initial short position here was down at position 1, where it had just broken out below a new low of the day. It reversed against him, price, and the 10-period regression line went back through the dragon, which is at 10-period Bollinger Band plus or minus a half, which we use as a smoothed directional indicator. And so ended up taking a minus about 0.4 or a 0.49 loss on this trade. And he asked me the following questions. What did I think about those entries and exits, and what could I observe? And so the points I made, and pardon my handwriting, I was on a tablet at the time without a cursor, and the points I made was that I like this entry at 2, blue circle 2, where he's red circle 1. I like the entry that it broke out to a new low. The day had been down. The market has been weak, and it had not yet traveled a range statistic from the high of the day to a potential range stat. So there was still reason to believe that there was a 2-to-1 risk to reward on the downside. So that is perfectly in keeping with our strategy. I would not have objected to a short a little bit sooner as it came out of the dragon, but still waiting for confirmation, a new low of the day. There's nothing wrong with that. I think the blue circle 1, this is also another good place to get that entry. The idea being that it collapses below this low of the day, then we have potential for a runaway move to the downside, much like this first move here from the Bollinger Band mean down to the low of the day. That's the kind of the size of move that we can not be surprised if we see that. And the whole trend of the day is down. You can see the river sloping down, the 270 regression line sloping down. Everything was pointing to that as a good trade. And he took a managed exit here with a minus 0.4, I think it's 0.49 loss. And that is a perfectly reasonable trade. Good entry, good exits. I like the trade. My other observation is that on a generally down day after this grinding move up, when we have a regression line crossover outside of the river, so out here in the floodplain, and then price comes back through the dragon, our initial target is the Bollinger Band mean, you can actually take this position short as it breaks through the dragon, but waiting for it to leave the river here in this blue circle, there's nothing wrong with that. I don't mind any exit short that is south of this dip in the dragon. See that lower skin of the dragon? When it price and the 10 period break through that, this is really where I want to target my entries on the short side, because now I have a measured target to the low of the day, and then with a tight stop in here, this is still giving me a favorable reward to risk, and I like that trade. So all in all, not a bad trade, but there are a few places where we can add some refinements to our technique. Here is one in, let's see, this looks like VXX. And so the entry was here on a higher low. I like the fact that he's catching it in a rising channel, but at the lower end of this band, but in a rising tide. That's actually very sound. He's using a 38-cent stop. That's reasonable for VXX. But what I want to observe here is I've got two price excursions where I have left not only the river but the floodplain also. So these are two Z3 patterns, meaning it's gone beyond Z plus 2 all the way out to Z3. His exit is when it falls out of this sideways quiet channel here at the bottom. And so what I want to say is that in these markets, when you can have more than an R in hand, you need to be capturing more than this last possible exit down here. This turns into a 0.3 or a 0.4 R win, but up around here at 26.35, we're holding 50 cents gain on about a 40-cent stop, so we're up around 1.2. So this gives back 0.8 from here to here. So I would like to see an exit not later than, say, the return to the Bollinger Band mean, or preferably at the edge of the river. In both of those cases, you get a really good return on time and money, and so I'd look to refine that technique a little there. Here are some of my trades in DIA. This is a good proxy for those of you trading the Dow Mini. This was these are 3-minute charts. So here is the open, had the nice gap up, a sideways quiet channel essentially developing. I get long here when the 10 crosses through the dragon, comes back, finds support at the dragon's northern skin, and gets ready to take off again. So I get long here, but I exit shortly thereafter when price comes back through the dragon, and the 10 comes out of the dragon to the south side. So there's a fractional loss on this. My initial risk would be down below below the skin of the dragon here. So that's about a 0.5 R loss. And now we've got a downward trending day. When price comes out of the dragon again the second time, I'm slow, but I get my entry here. You can actually see this as a Z3 pinch channel breakout, a Z3 PC. We have the Z3 bands have pinched, it's sideways quiet channel, exceptional pinch. When it breaks out below the Z3, I can get short here, so that's a Z3 PC entry. I cover down here near the regression line crossover and make back what we lost here plus a little bit more. When price does not emerge from the dragon but rolls over again, I get short once more. Now the day had been starting to get quiet, so when price comes back in, I just scratch this one. I stop and reverse because I had an RLCO outside of the river. The rest of the market was looking up. The S&P and the XIV were both leading indicators of a potentially good move here. So I like looking at those faster moving, more volatile instruments and then executing in DIA or the Dow futures, which will often lag them. The Dow, because it's the size of the underlying instruments, when it makes its turn and goes, there's some enduring momentum in that, and so that suggests that those other things ought to keep going, and they turned out to have pretty nice trades in that early afternoon session anyway. So we get long again around 16125 with about a 20-cent stop down here. It could be even a 10-cent. And then we get a nice cover up here at 162. Even with a 20-cent trade, that's about a 3R gain right here in a very orderly fashion, with the RL10 coming back, crossing the 30, and then coming back to the dragon. That's our natural normal exit. So that's some routine wave trading, if you will, using the Dow minis. And I think that's everything I wanted to look at. So that's Ken Long at Tortoise Capital. Keep your risk measured and your powder dry.